Today we're going to be doing grade 9 topics. I will start with accounting equation, but before I even go to the accounting equation, I'll start with the most important definitions in accounting. And the first definition will simply be about your assets. Question is, what are assets? What is accounting in the first place? Let's just explain and define what accounting is, all right? Accounting is simply the management, processing, and communication of financial information about economic entities such as businesses and corporations. Now, assets, guys, an asset is a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow to the entity. So anything that we are going to use and convert into cash will be an asset. Okay, for you to control an asset, you need to prove that it belongs to you. For instance, if you have a car, to prove that the car is yours, you need a license disc and it needs to be registered in your name. And the past event is the purchase of the car, agent going to the dealer to buy a car. The economic benefits, the future economic benefits embodied in an asset is the potential to contribute directly or indirectly to the flow of cash and cash equivalents. But this is quite difficult for grade 9 and 10. So I'm simply going to ask you to write the following simple definition of what an asset is, okay? So an asset in simple language is a resource that the business controls, is used to generate money for the business. So it's a resource that the business controls and it is used to generate money for the business. That's what an asset is. It's a resource that the business controls that will be used to generate money for the business. That's what an asset is, right? And I explained here with what type of assets we got. We've got tangible assets and intangible assets. As you know, tangible assets are assets that you can touch, but under tangible assets, they included the current assets and fixed assets. And I just need to explain that the definition of cash is not hardcore cash anymore. So it can be plastic money, all right? And intangible assets, as I said, are assets that you cannot be touched. We're talking about goodwill, patents, copyrights, trademarks, brand recognition, business methodologies. All of those are simply intangible assets. Under current assets, we've got cash equivalents, accounts receivable, stock inventory, short-term investments, and the fixed assets, which are assets that last longer. And I will explain what the difference is between current assets and fixed assets shortly. We've got buildings under fixed assets, we've got machinery, we've got equipment, we've got tools, and we've got furniture. All of those will be fixed assets. Now let's go deep into it. I will start first by explaining what a current asset is. A current asset is simply, these are assets that are expected to be used or converted into cash within 12 months, like your trading stock. Trade debtors. Trade debtors are the people that owe the business. We've got consumable stores on hand. We've got bank, accrued income, prepaid expense, petty cash, cash flow. All of this will be dealt with separately later on in your accounting syllabus. Okay, trading stock is simply it's simply items that we buy in order to resell at a higher price. That's what trading stock is. Here also included that bank is the most liquid current asset. That is because bank is the most used up current asset in a business. And then we've got non-current assets. I showed you buildings of factories and the CBD of the Sentin city there. So what are non-current assets? These are assets that are expected to be used or converted into cash over a period exceeding 12 months. So they last longer. We expect to use them for a longer period of time. And I gave examples of buildings there, right? Now, examples of non-current assets will be equipment, machinery, patents, copyrights, and land and buildings, etc. Note that land and buildings does not depreciate in value over time. Instead, it appreciates in value. So that's one asset that you need to take a look at if you want to invest your money, because this asset here, it actually appreciates. Appreciates means the value goes up as time goes, right? Unlike any other asset where the value goes down. Now, this is how we deal with the assets in the general ledger. The increase on the debit side. So remember this, the debit side is the left-hand side, the credit side is the right-hand side. Your assets will increase on the debit side. And the fact that they increase on the debit side, it simply means that they decrease on the credit. And assets will normally fall under the financial position account section in the general ledger. We will do the general ledger later on. Then we've got liabilities. A liability is a present obligation arising from the past events. That's when you borrow something or you take an activity that will result in you having an obligation to repay someone, right? The settlement of which is expected to result in an outflow from the entity of money, right? It results in an outflow from the entity of money. That is what the liability is. It will result in an outflow from the entity. All right, now let's just continue. That's what a liability does. A present obligation, it is a duty or responsibility to act or perform in a certain way. Obligations may be legally enforceable as a consequence of a binding contract or statutory requirement. E.g., when buying on credit, the business will have to sign a credit agreement with the creditor that a person or the entity that the business owes. Note that the obligation must exist now at present. That is the most important thing. The obligation must exist now, not later, but now. It must be a present obligation. That's what a liability is, right? Liability is the past event is obtaining the obligation, which is obtaining the loan, and the settlement is the repayment of the loan or simply performing the duty. So the repayment is performing the duty, e.g., repaying the loan results in a decrease of cash or money. Outflow of resources entail the decrease of assets, e.g., your bank will decrease when the loan is repaid. Now, your liabilities also are divided into two. We have current liabilities and non-current liabilities. So current liabilities are simply obligations we expect to repay within 12 months, that is a year. And the settlement entails repaying the liability or performing a service to reduce the liability. And examples will be trade creditors. These are the people we buy from on credit. Accrued expenses, an expense we haven't yet paid, but we have incurred. Income received in advance, it's income we haven't earned yet, but we have received it. And the current portion of the loan, even a long-term liability, the repayments that we expect to make within the next 12 months, we're going to regard them as a current portion of the loan, and they'll fall under current liabilities, okay? And then we've got non-current liabilities. What are non-current liabilities? We expect to settle them over a period exceeding 12 months, that is a period exceeding a year. The settlement, as I've said, entails repaying the liability or performing a service to reduce the liability. And examples of long-term liabilities will simply be a long-term loan or a bond. What is a bond? Mortgage bond, guys. It is a long-term loan used to finance the purchase of property. This is a special type of a loan because actually with respect to a mortgage bond, you are not getting the money. You are getting what you are buying, which is property in this case. So the bank that offers you a loan will take the money and pay the person that you're buying property from, and then you will simply get the property. So you don't actually get the money for you to be able to go and pay the loan. That is the difference with a long-term loan and a mortgage loan. With the mortgage loan, you get the property, but you don't actually get the actual money to go and buy the property. The bank that offers you the loan gives you, actually pays directly to the person from whom you're buying from. And the person will obviously legally, that loan or that property belongs to the bank, even though it'll be in your name, but it belongs to the bank. That is why when you buy a property using mortgage loan, in most cases, you will not get your title deed. A title deed, that's why I said a title deed, it's proof that this asset, which is your property, belongs to you. And you will only get that once you have settled the entire amount of your mortgage loan, all right? And liabilities, how do we treat them in the general ledger? Remember, I said we've got the debit and the credit side. Your liabilities will increase on the credit side, meaning that they will decrease on the debit side. They increase when you obtain them, and they decrease when you repay them. Okay, when you reduce them, the only way to reduce them is to repay the loan or simply perform a service that will result in the reduction of that liability. Okay, and it falls under the statement of financial position, or it falls under the financial position section in your general ledger. All right, and then we've got owner's equity. Under owner's equity, you will find four things fall under owner's equity. All right, what is owner's equity in the first place? It is the residual interest in the assets of the entity after deducting all liabilities. So in essence, owner's equity is just your total assets minus your total liabilities. What remains is what belongs to the owner, okay? And owner's equity is what the entity owes the owner, because the owner will normally contribute capital into the business, and the entity will owe the owner share of profits in most cases, and we'll discuss that as we go. But for now, in grade 10 and 9, just remember that under owner's equity, the profits of the entity actually belongs to the owner, because the owner and the entity cannot be separated. It's just one person. But later on, when you do companies, it's a different whole ball game, and we'll deal with that later on, right? Now, under owner's equity, we've got capital drawings. shareholders' equity, and retained income. And we also have income as well as expenses. I will start by defining what an income is. Income is increases in money and its equivalent that results in increases in assets. So income increases in money and results in increases in assets and decreases of liabilities. It increases equity other than contributions by the owner. So it increases owner's equity rather than those contributions, other than the contributions that are made by the owners. Okay. Now, income includes revenue and gains. Please highlight that because it's very important. Income includes revenue and gains. So later on, when I say I've got a profit, just note that profit will be income. If I say gains, because profits are simply gains. If I say any type of gain, you must know that that type of gain falls under income, so it must be recognized as income. Revenue is simply turnover, aka sales, right? And these are examples of your income. You've got fee income, which is a fee that you charge when you perform a service, and then you get money for that. Okay, so you perform a service, you charge a fee, and the AKAs of your fee income will be your current income, your savers income. So you perform a service, and then are entitled to that income. So it's normally called fee income, service income, or current income. And then we've got rent income. Rent income, you get it by renting out your property. All right. Profit on sale of assets, it's when you are selling your assets at a value higher than the carrying value. We'll deal with that when we actually later on this year, when we do the general journal in detail as to what profits on sale of your assets is. And then we've got sales. Sales is simply the selling price. When you sell, remember I said trading stock are goods that we buy in order to resell at a higher price. So when you sell them at a higher price, you recognize sales. All right. Commission income. Commission income is simply income that you get when you get paid on commission basis. Basically, commission basis is when they say to you, if you sign one client, we're going to give you 10% of what the client pay as a fee. So that's what commission income. So it's based on how many, on your performance, how many clients you normally signed in, or how many clients join the company, and you get a percentage of what they pay. And for them to remain within the company, for as long as they remain within the company, whatever they pay will always get a certain percentage. That's what commission income is, right? Trading stock surplus, I will deal with this later on. It's when your trading stock that has been counted is more than the trading stock that is recorded in the books. The difference, you're going to record it as income, which is trading stock surplus. Bad debts recovered, it's when you write off your debtors and later on they pay you. So we normally say bad debts has been recovered. The money that they pay after you wrote them off, we regard it as bad debts recovered. It falls under income. And then we've got discount received. Discount received, it's when you are paying less than what you need to pay. So you're given a discount. So you pay less than what the purchase price is, what the stated price is. That's what discount received is. It falls under nominal account section. Income falls under nominal account section. And in the general ledger, question is, does income increase on the debit side or credit side? The answer is it increases on the credit side. Remember, the increase in income results in increases in owner's equity. Okay, I repeat that. Increases in income result in increases in owner's equity. Income increases on the credit side. Please remember to complete the handout that I've attached in Google Classroom as we go. Follow each of these sections and make sure that certain things are left them out. It is your responsibility to make sure that you actually write them and you actually make sure you complete the handout that's given to you. And the opposite of income is expenses. Remember, we said income results in increases in money, meaning that expenses results in decreases in money, and they decrease your assets and they increase your liabilities. It's simply the opposite of your income, and it decreases owner's equity rather than those decreases relating to distributions to the owners. Remember, we distribute certain things to the owners. We'll deal with that later on. Expenses include normal expenses and losses. So we've got losses. So losses will be included under expenses, all right? So when I tell you that we have a loss on certain things, you need to remember that a loss is included under expenses. And examples of expenses will be salaries and wages, which is what we pay our employees, audit fees. This is normally the fees what we pay to external auditors for auditing our books. We've got rent expense. Most businesses are renting their properties, especially the businesses that you normally find at malls. They are renting there. Okay, and so they pay rent expense, and we've got depreciation. Depreciation is the loss of value of your assets, and we've got loss on sale of the asset, as I've discussed on. It's the opposite of profit on sale of the asset. This is when you sell your asset at a value less than its carrying value. This will be discussed later on. And then we've got directors' fees. Directors' fees are for companies, that falls under companies where the directors who run the business, they get paid directors' fees, which is an expense. It must be shown separately from salaries and wages. So directors' fees must be disclosed separately. That's why, even though it's a remuneration to directors, we don't include it under salaries and wages because it's material. We need to know how much directors get paid. We've got bank charges. These are the charges we get charged by having a bank account. Okay, like service income, time to think of it. We've got deposit fee, we've got bank credit card fee, all of those are bank charges. And then we've got interest expense, which is interest that we get charged on any liabilities. So they will all fall under your expenses. Expenses, remember, they decrease owner's equity, and anything that decreases owner's equity will go up on the debit side. Anything that decreases owner's equity will go up on the debit side. Please keep that in mind. Okay, anything that decreases owner's equity will go up on the debit side. So expenses decrease owner's equity, they go up on the debit side, meaning that income increases owner's equity, it'll go up on the opposite side, which is the credit side. Okay, so hence I included here that all accounts that decrease owner's equity increase on the debt side. Then we've got capital. Capital are simply contributions to the business by the owners of the business. These are contributions to the business by the owners of the business. Capital is simply contributions to. All right, the owners may contribute cash, assets, or their skills to the business. So any contribution by the owner will be recorded as capital. Okay, now how do we deal with capital in the general ledger? How do we deal with capital in the general ledger? So capital will increase because capital will fall under financial positions accounts section. It will increase on the credit side because it increases owner's equity. Okay, it will decrease on the debit side. And we have all accounts that increase owner's equity will increase on the credit side. Then we've got drawings. What are drawings? Drawings are simply distributions from the business by the owners. By the owners of the business. So they are distributions from the business to the owners of the business. All right, that's what drawings are. These are distributions from the business. Now, these distributions are to the owners of the business, okay? It can be in terms of cash or assets and may be distributed. So cash or assets may be distributed to the owners of the business. Any item taken by the owner for personal use will be regarded as drawings. Please highlight it. Any item taken by the owner for personal use will be regarded as drawings. So it can be the owner buying a car for their spouse, so that will be regarded as drawings. Or it can be the owner buying a car for their child, or the owner buying a console for their kids for personal use, or anything that the owner, but they're using the business card in that case. Anything that the owner takes from the business for personal use will be regarded as drawings. So how do we deal with drawings in the general ledger? Drawings reduce is the opposite of capital. Remember, capital is contributions to the business. Drawings are contributions from, are actually distributions from the business to the owners of the business. So they will increase on the debit side. That is because they reduce your owner's equity. Any account or any accounts that decrease owner's equity will actually increase on the debit side. Now, the spreadsheet will be divided as follows. We've got assets and liabilities that provide information about the financial position in order to calculate the net worth of a business on a certain date. And expenses and income, they tell you about the performance of the business. They provide information for the statement of profit or loss in order to calculate the results of activities, that is, calculating your net profit or net loss. Drawings and capital provide information about how much an owner has invested in the business. Obviously, that is the net investment that the owner has made into the business, which is simply in terms of drawings, which is what the owner takes from the business, which is a repayment in essence of the business to what the owner has contributed in terms of capital. Okay, and now your accounting equation will simply be where your assets are equals to owner's equity plus your liabilities. Please note, assets represents what the business owns, and owner's equity is what the business. And liabilities are simply what the business owes the lenders of the entity. So the right hand side is owe and the left hand side is own. So what you own will equal to what you owe. All right, in most cases, the right hand side are simply your financing of the left hand side. Okay. Now, the accounting equation consists of three elements, which are your assets, owner's equity, and liabilities. Now, as we said, assets always increase on the debit side. The increase will be shown as a plus in the accounting equation. I repeat, assets increase on the debit side, and the increase will be shown as a plus in the accounting equation. Assets will always decrease on the credit side. The decrease is shown as a minus under assets in the accounting equation. Okay, now owner's equities, I've said, increases on the credit side and decreases on the debit side. Two things increase owner's equity on the credit side, and that will be capital and income. All right, and two things decrease owner's equity on the debit side, and that will be your drawings as well as your expenses. Highlight everything that I've highlighted there because everything is very important. You abbreviate this, you'll get side. Okay, C it's for capital, I it's for income. Those increase owner's equity on the credit side, and we've got debt, which is DE, stands for drawings and expenses. They decrease owner's equity on the debit side. They decrease owner's equity on the debit side. Okay, an increase in owner's equity is shown as a plus, and a decrease is shown as a minus. Now, as I've said, drawings, expenses, assets have a debit balance. So abbreviation will be debt, D for drawings, E for expenses, A for assets, and D for debit, okay? And all of those increase on the debit side. And then we've got capital, income, and liabilities. They increase on the credit side, and that will be your SOC. Remember those abbreviations. And these are simply a summary. This is simply a summary of our accounting equation. What falls under asset, what falls under owner's equity. You'll realize that owner's equity normally decreases on the debit side, and it increases on the credit side. Okay, owner's equity decreases on the debit side, and it decreases on the right. That is what you need to remember. Just read what falls under expenses and what falls under income and what falls under liabilities, because all of that is important in making sure that you understand the accounting equation. Okay, accounting equation is simply a balance. Okay, so balance will simply be where you have your assets is equals to owner's equity plus your liabilities. Now, in completing the accounting equation, these are the steps that you need to follow. Identify the accounts that are affected. Step number one. Identify the elements into which each account falls under. We have three elements, which is your assets, owner's equity, and liabilities. Identify in which of those three elements your account falls under, and then determine whether it increases or decreases that element. Okay, that is your last step. Determine whether the account increases or decreases the element. Note that drawings and expenses decrease owner's equity, and capital and income increases owner's equity on the credit side. Please highlight everything and make sure that you are right. What we're going to be doing this example here, check out the next video. Note that for you to be able to access the notes, you have to join Google Classroom. I will actually attach the link to Google Classroom later on. Subscribe and make sure that you access the material on Google Classroom. We're going to be doing is make sure that you watch the next video.